In the next 3 minutes, I'm going to share with you how mortgage rates come to be what they are, and more importantly, how you as a real estate agent can explain that to your clients. It's Peter Chabris with Lockbox, where we provide our realtor friends with lessons in leads, listings, and leadership. And today we're going to continue our economics programming and talk a little bit about how mortgage rates come to be. The first thing we have to remember is how federal funds rates work. You may recall this from a previous blog post that we did, where we talked about how the federal funds rate is the interest rate that banks lend money in between each other, and how the federal government lends money to those banks. As the federal funds rate increases, that is to say, the baseline interest rate between banks increases, banks have to pass that expense on to the end user, whether it be a consumer or a business. And so as the federal funds rate increases, so too do interest rates that banks offer businesses and consumers for various financial products, or various borrowing products. Well, that all sounds great. Those are short-term interest rates, but what happens over time is that those increases in short-term increases in interest rates start to show up in long-term interest rates as well. Now, what most people don't know is that the mortgage rate, the 30-year mortgage rate, is not actually set by the federal funds rate. It's actually set primarily by the federal 10-year Treasury bill. The federal 10-year Treasury bill is considered one of the safest investments with one of the least amount of risk from large institutional investors around the world. Federal funds rate is indirectly impacts the 10-year federal Treasury bill. Generally speaking, the federal Treasury bill, whatever interest rate it is set at, about 1.7% higher is where you're going to find the average 30-year fixed mortgage rate. So we'll recap. Federal funds rate is the rate that banks lend money to each other. As the federal funds rate increases, so too do the rates that banks lend credit or extend credit to their customers, be they businesses or consumers. And over time, short-term increases in interest rates catch up in long-term interest rates. The federal 10-year T-bill is like a mid to long-term debt instrument that is considered kind of the gold standard of a return on investment for nominal to no risk by institutional investors. Because mortgages are collateralized by homes, they're considered a low risk, but ultimately riskier than being paid back by the federal government. And so a risk premium is generally associated if they're going to buy something riskier than that 10-year T-bill. And so generally speaking, a mortgage rate is about 1.7% higher than whatever the T-bill is. So for example, right now, T-bills are paying around 5.3%. As I film this video, interest rates are about 7%, or roughly 1.7% higher. That's how mortgage interest rates are determined. Generally speaking, there's some other factors, and now you can explain that to your clients and sound like a lot smarter a realtor than the average realtor when they ask you how the heck do mortgage rates get computed. Hopefully this was helpful, and I'll see you in a week. Thanks, guys.